Hey everybody, Spartan here from SpartanTrading.com. I want to hit you guys with a quick educational video today, and in this video I want to talk about option premium. So what is option premium? Now, a lot of people that are new to trading options, or maybe you've been trading options for a little bit of time and you're just curious to get a little bit more information in regards to this term, should know, what exactly this means. Why? Because it is something that is extremely important when looking at contracts and looking to trade options, because there's premium built into every single contract that you look at. Now, the premium is going to be different based off of a in-the-money contract, which would be a contract that is in the money, meaning the price of the stock or the common is above that option strike or at that price. So let's say the strike's 120 and we're looking at Afrin right now, it's at 127.83. That would be an in-the-money contract because those contracts are in the money at expiration. If the contract's out of the money, then we're looking at something that would be higher above the price if we're looking at a call, let's say. So in this case, we would be looking at a 130 call, and that would be something that's in the money. Now, when we look at, out of the money. When we look at something that's in the money, what constitutes that premium? The premium is going to be the difference between the intrinsic and extrinsic value. That's going to make up the premium. And when we look at the out of the money contract, it's just going to be the extrinsic value. So intrinsic and extrinsic value on a in the money contract are going to be the difference between where the price is right now, where that strike price is, and then the value of time to the expiration and the implied volatility as well. That's going to make up the majority of that premium of the contract. When we're looking at an out of the money contract, we're looking at the difference between where that price is as well to where the price of the current stock is. So basically the price of the strike to where the current price of that stock is, the probability of that contract getting in the money, which is going to be determined by how much time there is until that expiration, as well as that implied volatility. And that's what we would call the extrinsic value. Now, don't get carried up with, intrinsic and extrinsic. It doesn't really matter, those terms. What matters is you understand that the premium is determined based off of implied volatility, how much time the contract has left to expiration, as well as where the contract is in compared to where the stock price is. Now, you've probably heard before stock replacement, and when we see stock replacement, a lot of the times those are fairly deep in the money contracts. Like, let's say we're looking at a Tesla. Tesla's at $750 right now, and we're looking at, let's say, a $300 contract. Those $300 contracts are probably going to be very close to the difference between $300 strike minus that $750. That's what they're going to be, that's what they're going to cost. Why? Because the probability of these being in the money at expiration is going to be extremely high. So it really doesn't matter what the implied volatility is. That's not going to juice up those contracts premiums, as well as the time to expiration isn't really going to juice them up. Because the probability is so high, it's built in. Now, when we look at something that's out of the money, the probability is not going to be as high. There's a chance that they couldn't get in the money. They're going to have some sort of premium price on those contracts, and you'll notice that as implied volatility increases, like AFRM, where it became very volatile at the end of the day, you can see that these 130 contracts, went from next to nothing, 30, 40 cents, all the way to $3 fairly quickly. And by the way, it's Thursday, and expiration on these contracts is tomorrow. So you can see how powerful that implied volatility is to affecting premium. So hopefully this helps you guys. Just wanted to explain it to you how I think about it. I think it's, there's a lot of things that you can read and information there out on Google, etc. But I think, a little bit of an example and kind of explaining it in layman's terms may help you guys. Anyways, that's it for this video, guys. If you have any questions, you go to SpartanTrading.com. Otherwise, I will talk to you later, and have a good one.